Mr. Andrew Au, Ms. Rachel Teo, and Professor Ramkishan Rajan. Can I please on stage, please? The floor is yours now.
You know, as we talk about sustainability in the time of uncertainty, we have heard three very different perspectives that we can now weave in to a discussion. So we heard from, Andrew on how blockchain and decentralized finance is having an impact, and how it's also being impacted by the move towards sustainability in economics and in business. And Rachel gave the investor perspective. Of course, Tishan just gave the capital markets perspective. And kind of my background, I'm the CEO of APAC Advisors, and I work predominantly now with private equity firms on their ESG and sustainability initiatives. And going back about a long time now, 25 years or so, I used to work in the United States government and was Deputy General Counsel at the U.S. Department of Transportation. So something Rachel said, really hit home, and I agree with her completely, in that when it comes to government action on climate change, it is very likely to be delayed and disorderly, and that the government is going to act in a very abrupt manner to crises. They're going to give businesses and investors very short notice. It's going to result in disruptive policies, and it is going to come with unintended consequences because they're not going to have thought through their action. So that's what we're going to see from the government side. But we're going to see a lot more pressure and a lot sooner, sooner pressure, and I think more intense pressure from the new regulators. And the new regulators, it's not the government. The new regulators, who are going to have a much greater impact on sustainability, are going to be the employees of the companies, and they're going to be the customers of the companies. And they're going to be demanding action, and they're going to be demanding it much faster. So this leaves investors in a very tough position, without government regulation coming when it's needed, and having to respond to investor, customer, and employee pressure. And so I want to ask Rachel kind of the first question, and then Andrew and Kishan to follow. Given the scenario we're in, what are the new emerging issues that financial markets and investors should be thinking about and being prepared to manage when we see what's coming when it comes especially to the climate crisis?
On new emerging topics that investors and markets should pay attention to, besides climate change, there's income inequality, which is a big area of research that we are working on. Right, that disruption could be possible. So maybe I'll say a few words on that front before moving to the climate aspect. So what we've done was to develop an indicator to look at income inequality in each countries. We looked at it for about 27 to 30 countries, and we look at it holistically. We're not just measuring Gini coefficients, but we need to look at inequality in income, in wealth, and in opportunities, like access to education, healthcare, and credit, and so on. So we need a very comprehensive measure of inequality that I think we still are lacking. We're still trying to develop that view. And using that data, we looked at the impact of socio-economic inequality on growth and inflation and financial markets. And the results are quite stark and worrying. Right? First, I think beyond a certain per capita income, rising inequality has a negative impact on economic growth. And it actually has a positive impact on inflation. Because when societies are more unequal, those with greater influence, the richer groups, they actually prefer inflation versus fiscal spending when you are hit with crisis. Right? The preference is inflate rather than spend. So there's this political dynamic underlying higher inflation. And we also found in our research that it is a driver, rising inequality is a driver of populism. Because it's fragmented society, once governments will change, they want better policies to mitigate inequality. But then when you explore the policy platforms of populist parties, they do not necessarily advocate or eventually implement the redistributive policies that mitigate inequality. In fact, their policy platform tends to be more nationalist. It tends to be anti-globalization, more protectionist, which actually worsen the growth outlook, right, and worsen the underlying inequality dynamics. And so it's very worrying that we have a problem. As an investor, you look at it, right, that the political system may have a challenge trying to resolve the inequality issue that's been driven by technology, right, and economic forces. How will that get corrected will be a big issue to think about, right? And in strategic asset allocation, as investors, what are the scenarios, what are the disruptions from that? We look at the impact on financial variables, financial market returns that matter to us as investors. Higher inequality is associated with higher country risk premium because of the inflation uncertainty and political uncertainty. And very strangely, or rather, in a perverse way, higher inequality was associated with higher equity returns. Right? Listed companies actually benefit from rising inequality. So we did a few more pieces of work, right, to understand why. And actually, it's not difficult to understand the intuition. It is because of the wealth accumulation process, right, that we are going through. The listed companies represent the best, most well-performing companies, given the underlying technological forces, right, that's generating economies of scale and network externalities. Right, the winners gain a lot of market share, they grow faster, they will get listed on the stock markets that we invest in today. Right? So there is this positive relationship in the wealth creation process, right? And also the well-to-do and the rich-to invest their earnings into markets, and that support valuations. But the question is that, will these tailwinds experienced by listed equities continue, right, to persist? When will listed companies get disrupted by anti-competitive policies, anti-competition policies that we are already beginning to see signs of? Will the stagnating, headline GDP growth eventually hurt the top line growth of companies? And will they also suffer in the profitability in terms of the anti-globalization policies, right, that's reducing market shares for large international companies? So these are, I think, the questions, right, that investors need to think about. And then in terms of actions for us, right?
Actually, I want to bring Andrew in, because where does blockchain and decentralized finance fit within the scenario that Rachel just played out? Is this going to put an end to income inequality when you decentralize finance, or is it going to keep those tailwinds going in the favor of the haves?
Yeah, look, I think in my speech earlier this morning, we talked about that trust gap that's developed and Main Street versus Wall Street. So definitely, to answer your question, Stephen, and pick up on Rachel's point, technology disruption, and even the effects of COVID, the COVID pandemic, has definitely brought to the fore inequality issues. So at the heart of essentially the DeFi and blockchain movement is more about financial inclusion and inclusiveness. So I think definitely there's already an impact. We're seeing it in some of the projects that I didn't have time to expand upon, but if you look at developing markets, you're already seeing live DeFi projects in place. For example, to address the United Nations SDG Goal 1, no poverty, you're already seeing, as I said, birth certifications completed, and the No One Will Be Hungry, SDG second goal. We're seeing food vouchers already implemented on the blockchain in Ethiopia and Africa. So I think that's definitely answering and addressing that. But just to pick up on that point, maybe make it a light discussion, technology disruption, big tech, fintech disruption, we've been involved in that decade, it does disrupt and create, to some extent, inequality. And I think that's just a byproduct that we have to adjust, and governments are not necessarily quick to respond. Having launched an ESG platform ourselves this year, we've looked at the impacts that Dr. Rakesh talked about greenwashing, etc. I think what we're seeing from an investor hat perspective is that stakeholders, as you mentioned, consumers, the family offices that are looking at impact and not just bottom line, to Rachel's point. I think that is now happening. That has now become more mainstream. We're seeing countries, not just in the UK, China, you're seeing it across the region, and develop ESG reporting. So it's no longer just the asset allocators that are looking at that. You're seeing it across the board. So I do think it's a very interesting topic that inequality is addressed by looking at investments from a more balanced perspective rather than just one.
And Keisha, maybe you could build on a point. I thought you had said, or at least the shorthand I took away from one of your slides, was that there's too much money going into ESG too soon. Can you expand upon that?
So far when we've been thinking about climate change, the real focus is on the Minsky movement and carbon level, etc. And that's certainly true over time, if nothing else. If we don't have this, if investors, central banks, etc., governments don't make the change, don't make a transition. The problem is, like any other kind of market, given that central banks, remember, all this happened from 2019. So from 2019 to in 3 years' time, you see so much attention paid to climate. Yes, you could say it's all pressure cooker, we should have done it long ago, but fine. But when you have all this attention and suddenly all these so-called green funds being created, etc., and everyone, so I take what Andrew said, well, it's not just about what the firms or etc. say they are doing, it's the investors are paying more attention. But I think at a aggregate macro level, I'm not sure that's still the case. Certainly over time would be much more important. And so I think there's a lot of these funds have been set up. Given that we don't have any proper template that's consistent across countries about what is green, or issues relating to disclosures, etc. It's very unclear how a lot of these funds have come up and said they are really green, or they are consistent with the Paris Accord, etc. And so many investors, I think, are still fairly superficial about these things. We may want to do it right, and so we're not going to do all that research right now unless you're really committed to it, or you're fairly wealthy and you have people looking into it for you. You see a green, you might go into it. And so I think too much money has gone too soon. Now, as anyone would say, is it a bubble? So I just use the term bubble. The only way we'll know if there's a bubble is after the fact. But that's where I'm coming from. Let me, if you don't mind, just picking up on the point on technological development. It's not so much about inequality, and I think clearly it's important, but I'd also say it's wealth inequality, as they're increasingly talking about in Singapore. It's not just about inequality. Inequality has existed for a long period of time. It's the perception of fairness. I think that's the real concern. When you think about capital gains tax being taxed differentially in the US, not taxed at all in the case of Singapore. I'm not saying it should, but these are issues. But leaving that aside, when we think about technological development, I was thinking of Andrew's talk and then thinking about the first speech that we had today, and I was thinking on the supply side, all of this is well and good. It's important from economist perspective, great, it reduces transactions costs, etc., etc. But then I was also thinking, well, we think about countries like Singapore, etc., rapidly aging societies. It's one thing to say we can do all of this, it's really good for the youngsters, but what about the aging folks? We kind of be a good example there. They moved ahead, how have the aged adopted to some of these technological changes? I don't think it's happening all as well in Singapore. And there's some issue that needs to be paid attention to. And the other issue that Rachel pointed out was generally issues related to the social fabric of society. You think about, you do everything online with AI, etc. What does that mean for society over time in terms of less human contact, in terms of empathy, in terms of you have the gig economy and other things coming up, automation, what does that imply in terms of employability? Yes, people are going to the gig economy, what does that imply for skills upgrading, especially at the lower level? Eventually those things get automated in terms of driverless cars, etc. What happens there? What about their health care, etc. So these are so as economists, I like the supply side transactions cost reduction, but I think the consequences on the other side are potentially immense.
Yeah, and one of the things Andrew mentioned, and I'm turn to you, Rachel, first, if you're talking about the SDGs, the Sustainable Development Goals, is that the Sustainable Development Goals are, in many ways, are inherently in conflict with one another, right? So if you are going into, if you take a no coal pledge to achieve one of the SDGs, you are likely to increase poverty, right? At least in the short term, if not in the medium term, because you are going to be having people who don't have access to energy now. If they get shut off from coal right away, and coal-generated electricity, they're going to be much poorer. They're going to have much less access to education and food. So you need one of the SDGs, but you probably harm 2 or 3 others. And people don't seem to be taking that into account when they're talking about being sustainable investors. So how is GIC thinking about that theoretically when you're coming up with your sustainable frameworks and you're coming up with your impact algorithms?
Yeah, so thanks for the question. I think you need to be holistic, right? So one of the sustainability beliefs, right, that we really anchor our practices on is you need to be holistic when you assess, your investments. You need to balance the financial aspects as well as the social and environmental impacts, right? So when you look at climate change, and you look at a country or companies that need to decarbonize it at the country level, the policymakers need to make very difficult trade-offs. They need to trade off between decarbonization and energy security, decarbonization and economic competitiveness and livelihoods. These are difficult trade-offs that policymakers have to make. And then as investors, we can support, right, the kind of policies that governments need to put in place, but we are not in a position to make that trade-off, right? If we are asked to advocate for a certain set of policies, that might not be very fair, right? On the different governments who are actually facing very different local economic structure, different economic conditions, and different starting points. So I think as investors, we need to understand that policymakers need to make these trade-offs. We need to support. What we want to see is an orderly, right, process, right? And that all these different considerations are being balanced, and what we want to see is an orderly and smooth, and also hopefully pre-telecast decarbonization process. What would be ideal is that if different countries have a sense of how decarbonization is going to take place, a detailed roadmap if possible, so that as investors we know where the priorities are for different countries in the different sectors. We can identify the investment needs. We know where the policy supports are coming from, then we can channel right capital into these areas in the most productive and the most constructive way.
And Andrew, where blockchain fits in on things, I mean, the carbon credits help us get there, the carbon exchanges help us get there in terms of trading off from one country to another country in terms of their decarbonization journey.
Yeah, look, they're all incidental, and I definitely think we're going to talk about that. But I do feel, if I look at that question you answered, I feel like pick on that a bit. And I think of my own self, 25 years, started in Wall Street as an investment banker, then went to fintech, did a lot of disruption, was fortunate, and setting up Heritage Horizon Capital was about setting up the foundation. And if I look at my own microcosm of my career, I can see that Wall Street makes a lot of money, displaces a lot of things. Fintech displaces a lot of things, and you have investment mandates you have to stick to. It's very hard. There's a conflict not just in the sustainable development goals, but there's also a conflict in your own corporate mandate. And I think it's very hard to address. And I love the point that Dr. Ramkishan mentioned. Social fabric. When you talk about all this cool tech, the reality is over the last decade, billions and trillion-dollar companies have been formed. It's an insane amount of wealth. And it's been created off the backs of essentially societies. Governments and corporates could do all the things they can. But I think we as a society need to be more altruistic and a little bit more sensitive to that. And I think those that are fortunate to be in that position need to do more. And I think it's quite interesting in the US, for example, with the elections that have recently sort of come past. There was this topic of how do We saw Andrew Yang talk about the concept of, well, why don't we can tax the wealthy and the billionaires because they can afford to, and they're happy to. So there's certainly a lot of things that can be done there. And I think that's a difficult problem to solve. Do you want me to pick up on the ESG carbon fund?
Yep.
Or should Dr.
Well, why don't you go for it, and then we'll come back.
Yeah, so let me actually piggyback on that. So just the last part. Ideally, altruism, but absent that, or if you're more skeptical about human nature in aggregate level, not individual for particular individuals, that's where the role of government comes into play, right? And so what Rachel is pointing out, how do you manage? Yes, you want to manage this transition one way, but that also emphasizes the important. There are always going to be winners and losers. So I think of adapting to climate change and building up infrastructure, carbon tax, etc., as any other kind of reform or liberalization or trade liberalization, etc. There are going to be winners and losers. The countries that are successful in these big reforms and liberalizations are countries, apart from the political communication, etc., countries that have the fiscal space to help out the losers during the transition process. And so fiscal space becomes exceptionally important, which then relates to the issues when you have had, over the last decade, 2 decades, significant winners, and you need more fiscal space, and then takes you the whole issue about how looking for other sources of fiscal revenue, etc. I should also just make another point. When I teach in university, the other issue that comes about is, so I think all of us are on board in terms of transition rationally should be ordered, right? But it is a generational issue as well. You talk to a lot of the youngsters, they say, nothing has happened for so long. This whole idea of transition being orderly, well, it was, you have moved the other direction, the bias was the other way, there's no transition, and so you need to make up for that, and I don't care about the consequences. Many of them, obviously, they don't think about the macro level as such, but they think Singapore and other countries are probably a bit too slow in their transition process, whether it's petrochemicals, etc., etc. So there's a generational issue there, the tension there as well. So what we think is completely rational, because we're taking the entire picture as a whole, they say, well, it's already a bit too late, we need to do much faster.
And that was kind of one of my opening points, is that the new regulators are not the government.
Yes.
It's millennials and Gen Z who are going to be pushing us a lot harder than the government.
So maybe I'll just add something from an investor perspective. These are big problems, right? Sustainable problems that we are confronted with today. Generational challenges, climate change, inequality. Then, and we need collective actions, right, from all the different stakeholders, governments, businesses, consumers, investors. So what can investors do? So what we believe in is really 3 things, right? First, invest in solutions. We're investing in climate solutions. On the ground, we're looking for commercially viable, strong companies that can have a strong impact, but also strong financial performance. You scale into that. Right? Even in the area of income inequality, where there are solutions that can mitigate inequality, such as financial inclusion, access to healthcare and education. Those are the solutions we want to look for. Right? 2, I think, engage with companies, right, to help them understand the risk, prepare for the future. I think you can also advocate that companies should pay attention to climate change, the impact they have on the environment, but also in terms of diversity of their workforce, to advocate for, say, equal opportunities, not just in terms of gender and ethnicity, but also socio-economic diversity within their workforce and talent pool. Right? Because there's research from Harvard Business Review, for example, that said that their leaders, their workers from the lower socio-economic classes, they're actually very motivated, more motivated, and can actually add value to corporate performance. Right? So I think these are the 2 areas. And 3 is really integrate. Right? Investors need to be aware of these challenges and the impact it has on the companies and financial performance. Integrate them into the investment process. You cannot outsource, right, sustainability to a central group and think that the company has been investing, you've done the job. All investors have to consider, right, both the social aspect, the environmental impact they have, right, in their investment decisions.
Okay, you talk about commercially viable is the basis for investment, but unless, I'll get back to my last question, Andrew. Unless there is a tax on carbon a price on carbon that applies globally, how can you possibly have what would be a commercially viable investment when one company is taking into account the externalities and the other is a free rider? Don't we need to get the governments to step in, or else there's only so much investors can do? And governments haven't shown any ability to do that, and hopefully we'll be proven wrong, or I'll be proven wrong after COP26. But
Yeah, as an investor and a disruptor, I'm not putting my money on the governments moving anytime soon. I think if you absent the carbon tax, etc. I mean, if you're talking about the decarbonization initiative, you know, market forces can also drive it, right? There are a lot of viable projects. We invested in a algae biodiesel fuel, a biofuels company, and we've all punched the map. We know exactly how many hectares they need to produce, grow the algae culture, produce the jet and the biofuel to get carbon neutral in this particular ASEAN country. So it can be, and the biomass can be, it generates carbon credits which can be traded. So there's definitely a commercial viability and market forces and technology, because this company next also is on the blockchain and we're actually unitizing all those investments. So I think, absent the policies which we hope governments will continue to contribute, and think tanks and forums will contribute to, I think the carbon credits is a phenomenal incentive because it enables the free riders, to your point, Stephen, to buy. Whether it's oil and gas in those industries, go buy those credits, make yourself more commercially viable, and you look ESG friendly as well. But if you don't want to call it greenwashing, but I think that's really more, that's the market forces driving. And I think that generally moves the world for the last millennium. So we'll probably continue to.
Another thing of the carbon tax issue. So clearly, yes, in the first best world, if policymakers get their act together, they give it, as Andrew said, yes, you want a uniform carbon tax across countries. But you don't want a uniform lot of things across countries, nothing works, whether vaccination, etc. So absent that, you're exactly right, Steve, right? So what's the point? Well, you have the Switzerlands of the world doing $100 carbon tax, and then you have others not having any carbon tax, etc. This is where the EU comes in and says, well, we're going to have a carbon adjustment tax, right? And I suspect we may see a bit of that over time. There are two other possible sort of interesting scenarios that might happen over time from policymakers' perspective. One would be, and this was suggested long ago, where you have sort of this clubbing of countries, where a group of countries agree to have a set of uniform policies with regard to carbon tax, etc. Or more related to that is the whole idea of FTAs. That's basically what, when you think about FTAs, they are the same issues with regard to labor laws. We also have environmental standards in FTAs, right? So you might have a clubbing of countries that FTAs, as they get renegotiated, this might be an issue that comes up, and that they may have individual countries bilaterally or regionally might start harmonizing their carbon taxes or carbon adjustment mechanisms in that way, right? But not globally.
We have time for one last question each, or okay, one last question each. So I guess in closing, let's be positive. So what's what are you basing your optimistic view on how technology is going to address social inequalities when it comes to financial markets?
The optimism, I think that all the actors understand the challenges, right? And then we are all pulling our own weight in whatever ways we can to try to manage this. I think discussions, forum, awareness, research. I think a lot of big role can be played by research to create the awareness, to understand the impact. Tools analysis can be developed, right, for investors, for consumers, for governments to manage these different risks. And just one last point on the carbon credit market, right? There are a lot of challenges, right? Inequality, equality problems. But the fact is, we have a group, right? There's a task force for scaling up voluntary carbon markets, right? We are trying to address these challenges. To the extent that it can be resolved, then we can actually have a mechanism where carbon and externalities can be priced, and then these can be incorporated into business and also investment decisions.
Steve, I'm incredibly optimistic about the impact of, obviously, being where I'm looking at technology, but just because I've seen it. If you look at sort of COVID, we're doing our round of boosters. Well, there's 5 billion people on this earth that haven't even got their first dose. So, if you look at the inefficiencies, you can't do that with just policy alone. Nor could you do it with technology, which is not somebody saying technology is the magic wand. But I can see the impacts of technology in general, not just blockchain. Is really the theme. Is blockchain is about addressing the trust gap, enhancing that. I think technology is about being able to do a lot more with less, and it's also accessing more people. There are billions of people outside of the banking system. So when you talk about technology, what you can do with smartphones, and there are more smartphones, 3-4 times over in used iPhones that can address population size of 8 billion. We can all access a smartphone, which means therefore we can access market financing. Now, whether that be altruistic means or commercial means, if you're able to do that, then you're able to channel capital. And I think from that perspective, it sets a foundation. It's not a magic wand or a silver bullet, but it sets the foundation for then, commerce, market policy, regulation, and policy, government policy, to hopefully make this place a better and more empathetic world. So, very positive.
Yeah, no, I agree. I mean, in terms of, if you think about what Andrew pointed out, issues relating financial inclusion, etc. Potentially, technology can help with a lot of things that we couldn't deal with earlier. These are not new issues, financial exclusion, etc. They can be dealt with more. But I'd say in terms of optimism, I didn't go back to a more fundamental issue. I'm more optimistic. They can also be irritating at times, but I tend to be more optimistic about the next generation. I mean, they're much more, the very fact that they're willing to debate, engage, think about broader issues. Now you could say, well, our generation gave them the necessary income and wealth, etc. for them, Maslow hierarchy of needs. But the fact is that I see over the last 20 years of teaching that this current generation seems to be much more engaged in some of these issues. We may not always like what they say in terms of too slow at things, etc. But the fact that they're talking about have a holistic view of some of these things beyond just themselves, that makes me very positive.
Like I say, when I see, GIC, venture capital, and NUS all moving in the same direction, that gives me reason for optimism. So, thank you to my fellow panelists, and thank you very much to the organizers for having us. Thank you.
Thank you.
Thank you, Greg.